Hey everybody, Kyle, not your average finance guy. Just made a video about a Roth IRA and setting that up, as early as possible. And with all of these strategies, it's kind of like when was the best time to plant a shade tree was 30 years ago. When's the next best time is right now. So no matter how old you are, get into this stuff. The sooner you can get into it and the more time that you have rolling through this all, the better it is. So this is the next one here. I just made a video on the Roth IRAs, and I think that's a great one. So please check that out. That's more for retirement. And now to get, if you've got anything over and above the $7,000 a year that you can throw into that Roth IRA, then I would go to this next, the IBC method. So what the IBC does is the infinite banking, not pissing away all the interest to the bank. You still do have to pay interest, but you're taking that function back into your own self. So it takes a little bit of seed money, sprout money to get going, but at some point you're going to have to buy another car, right? Maybe you've watched some of my velocity banking videos, and we got out of the credit card debt, we got out of car debt, and you can run the numbers forever, but at some point you're going to need a new car. Okay, and what do you do then? Do you go back to the bank? Then they crawl up your ass and ask you all the questions and make sure that you can pay their money back, and to check your credit, and they check how much money you got, how much your house is worth, and what's your 401k, and then they look at all that stuff. So with this, it takes that function back to you. So you don't have to ask anybody. You've got your banking system set up. It's already there. Ask myself, I would like to buy this new car, and I check my cash value. Yes, I can take a loan against that cash value, and you write the check. You ask the insurance company, and here they give you the money in your account in a couple of days, and you take that, write a check, and take care of the car, and then you just keep, instead of making payments to the bank, you make the payments to your infinite banking policy if you want to redo it. If you never want to do it again, then don't make the payments, and you never can. So you probably would be able to at the way down the road, but if that's your mentality that you want to put this money in once and buy one car and you're done with it, this isn't going to work. Don't do it. Okay. But if you want to use this to buy every car that you are going to need for the rest of your life, then this is the way to do it. But you have to put some money in up front. Basically what we're going to do is it's like paying cash for a car. If you put the money into a savings account, say you're going to buy a $20,000 car, and you save up and you save up and you get your savings account to $20,000. Once you buy the car, savings account is gone, right? So now I guess you could keep making those payments and get that savings account built back up. But what the infinite banking concept does is, say you got that, you saved up $20,000. What we're going to do is you're going to borrow against that. Okay. You're not actually taking your $20,000 like you would in a bank. You're not taking it out. What you're going to do is you're going to borrow against it, because this is like your death benefit. You borrow against that. This $20,000 still grows at whatever the dividend rate is. This year it was, I think it was six point something was the one I had. So that your whole cash value of say $20,000 continues to grow in cash value in that dividend rate, as long as they make the dividends, which they have every year since basically the Civil War. So as long as that happens, that continues to grow, and you can continue to borrow against that. But as long as you pay that back, then the next time, in 5 years when you need another car, that $20,000 will be $40,000. Or what, it depends. Everything is different, but I've got one situation here that it's an actual illustration from Penn Mutual that I got from my buddy MC Lobsher, that he sent that over to me, let me talk on it. So let's jump in and kind of go through what this is. So kind of like my last video here, I was just at Christmas, and we got a bunch of 25-year-old nieces and nephews that are kind of asking me some questions, and I said, get that Roth IRA going, and here's what I would do second, because let's take that banking function back and pay yourself back that interest instead of the bank. So this is for a 25-year-old male, preferred non-tobacco. So quit your vaping bullshit and let's get off the tobacco. And then this is what the numbers will be. So these are, I will say it, non-guaranteed. Okay, there's a guaranteed section and there's a non-guaranteed. The guaranteed is usually between like 2 and 3%. Then it is contractual, so this is guaranteed to go up in cash value. Now, because this is non-guaranteed, that means that if the company does well, it will pay dividends, because what we're doing, Penn Mutual, like anyone else, it's a mutual company. It says it right there in the name, which means that everyone who has a policy is also part owner. So you share in the growth and the well-being of the company. They pay you dividend every year, and that's kind of how this whole thing is going. And because this says it's non-guaranteed, in my mind, doesn't really mean anything, because they have paid dividends literally since I went back. I've got a Mass Mutual ABC policy, and they went back and they paid, like, I think since 1867 they've paid every single year they paid a dividend. Okay, that was like, I think it was I remember it was 1867. It was 2 years after Lincoln got shot. I know it was when they basically started the company, started paying dividends, and they never missed one. So through the Civil War was just ending. We're going through the Great Depression. They kept paying dividends through the Great Depression. So what does that tell you? Through World War I, World War II, the dot-com bust, the Great Recession of '08, and everything else in between, they've paid dividends through it all. So even though it's non-guaranteed, it's probably going to happen. So let's go through, and that's what we're going to look at here. So what I've got here is just, you can make these go however you want. If you're 32 years old, you're 32-year-old female, yeah, it's going to be a little bit different numbers, but this is just an example of what's possible out there. So in this one, I've got a $10,000 premium outlay. So say your premium is $10,000 every year, and you can go higher, you can go lower. You can kind of, there's a couple tests to figure out, where you want to be with that, but you want to be able to put as much in here as you possibly can. It'll only help you save for the future. Okay. So with this, you're 20, starting when you're 25, so 26, your first year, you got $10,000 into it, and we're putting in $10,000 every single year. So you see here, after 10 years, you'd be age 35, you would have put $100,000 into it. Okay, your dividends would have been $16,600. Premium outlay, again, is $100,000 that you've put into it. So your total net cash value after 10 years is $112,750 basically. Okay, so at this part, so it does take a little bit of time to get this whole thing moving. But what would you do after 10 years if you could diligently put away $10,000 into a savings account, and at the end of 10 years you have $100,000? Okay, or what's a savings account pay? 0.06, so maybe you've got, we'll say, $101,000. All right, where here you've got $112,000 that you have access to, that you can borrow against. In 10 years, do you want to buy a house? You're going to need a down payment. There it is. You can borrow this, up to usually about 90% of your total net cash value. You can borrow against it, and you can buy a house. Maybe in 3 years you need to buy a car, so you can take out a loan against this at, say you need 20 grand for a car in 3 years. But you're like, but in 3 years, I've put $30,000 into this. You're right. So that's where it takes a little bit of time to get this going. But if you take out a loan of $20,000 in year 3, and you go whatever the car dealership says, you owe $500 a month, pay $500 a month back to this account, back to your IBC policy, instead of pissing it away to the bank. It's gone to the bank, it's gone forever. Pay it back to here. Now in 5 years or so, you're down here to year 8. You're back to $83,000 that you can now borrow. Okay, do you want a house? Do you need another? You're going to need another car, right? So what if you take another 20 grand out at that point, and then you can maybe take another 50 for a down payment on a $200,000 house. So that's just kind of how this whole thing works, and that's within the first 10 years. And after you get through that first decade, basically, I know it's hard to see past this weekend, let alone in 10 years, but what's going to happen to a 25-year-old in 10 years? You're going to be 35 years old. You're hopefully happily married and got a kid or two. And, that's when life really starts to kick in and really starts costing you a lot of money, because when you're young and dumb and you're still living with your parents, you got a great job, you got nothing to spend your money on, but, going out to the bar and having fun. And how much fun is that? You wake up hungover every weekend and you feel like shit. So put a little bit of money away and get this going, so that this is whole life insurance. So what this does is you have to pay this every year for the rest of your life. Basically, I'll show you at the end here where you don't have to anymore. The way this one's set up, and you can set this stuff up any different ways. You can do a 10 pay where you pay for the first 10 years and then you're done. You don't pay anymore. And this number, obviously, it doesn't grow by the $10,000 that you're putting in if you don't put it in anymore. But this, 112 would still continue to grow. But we're looking for maximum velocity here, so we're going to continue to throw $10,000 at this. So let's look at 20 years. You're 45 years old. You're roughly my age now, and you've got access to $318,000. And maybe you've taken loans out, but you've also repaid them. Just keep making those payments. Whatever the bank would charge you, is a good rule of thumb. Just make that payment. If you can't afford what the bank would charge you, don't buy it, right? So make sure that the cash flow and everything that you can afford all that, and even use the velocity banking method to pay this off. I mean, what better way to pay yourself off faster to have more access to your money? So here we are, 45 years old. You've got access to $318,000, and what have you put into it so far? You've put in $200,000. So just like that, you've got $118,556 that basically you made out of thin air. And guess what? Is this an investment? You can see right there that you're making a little bit of money. I would not use this as my only investment. I would use this to augment any other investments. I use my policy to put down payments on rental properties. I would take $50,000 and I would put it on a rental property. That rental property would generate a couple $100 in cash flow every month. I would take that cash flow and I would dump it right back into here. Any positive cash flow, I would get this paid back as fast as I can. And guess what happens once I get it paid back? I do it again. I do it again. I do it again. And you just keep making more cash flow. You got more properties, you got more headaches, but everything just keeps growing as long as you keep paying yourself back here. So if we keep on going down to the next page, so in the 21st year, this is the age. So what do you want to, should we look at when you're 55? You've put $300,000 into it. You've got access to $670,000. Now, I have not looked at this column at all yet because I don't care about this column. This to me is a banking function. But guess what? Say you took out, a $500,000 loan when you were 50 years old, 51 years old here, and you die. Oh shit, we just took out, if you're at the bank and you took out a $500,000 loan, they want that money back, right? And look here, if here you don't have to pay it back, it comes out of this. So guess what? Your heirs are only going to get $1 million instead of 1.5. All right. So that's I call this icing on the cake. I hope I never die. I know I'm going to at some point, but I set this policy up to get ahead in life, to be able to use this banking function to stop giving all my money to the banks. I want to give it back to myself and my heirs. So this is insurance. You are paying for some insurance, and that's why it takes a little bit to get this off the ground. The first decade basically. After that, then you're rolling. So let's go down 70. Say you're 70 years old, and right here, that's the way MC set this one up. So he said we're still paying about $10,000. That went down a little bit. I'm not real sure why. So 70 years old. You know what? I'm done. I'm retired. I'm not paying it anymore. Oops, sorry. I'm not paying this anymore, and so you don't have to. All right. So what this does now is it takes out a loan against your cash value, and it keeps making your premium. So you're set. You're set for life, and you're guaranteed a death benefit at the end when you die. If you don't have any loans out, say you took a million, you got $1 million loan out here when you're 70 years old, it just comes off of this. So now your heirs get 1.6 million instead of 2.6. Okay. You're basically accessing a portion of your death benefit during your life to use it and enjoy and to make your life better. And then at the end, you don't have to pay it back. And what's left that comes out of your cash value is just a little bit less of a death benefit that your heirs will get. All right. If you're this one set up for a 25-year-old, really don't have, unless you got some kids, you really don't have anybody to take care of at that point. But even if, let's go back up, say you have some kids, and in 5 years you've got an $800,000 death benefit. In 5 years, you put 50 grand into it. If you die, you get $885,000. That's pretty damn good. But I don't even look at that. I look at this early years as buying a car, buying a house. Hopefully, get down here and you can make some good investments that make some returns, that create more cash value, that you can take all that cash and dump it right back into here and just keep growing, or use part of it and go on a nice vacation. Take the family to whatever you want to do. Take them on a cruise, take them to the beach, ski vacation, whatever your thing is. So this is just something, and again, 25 years old, the earlier you start this, the better it is. So if you want to go all the way down to, I doubt I'm living anywhere past 90 to 100 years old, whatever. So at this point, we're taking some income from it. So let's see here. Starting age 71, we're taking $118,000 as income, basically. So you're taking that, instead of putting $10,000 a year into it, you're now taking $118,000 out of it. And you're taking, here you've taken $500,000, here you've taken 1.2 million almost, and look at your death benefit. You're still at 1.8. Okay, so that's why your death benefit starts to go down a little bit here, is because we're just taking cash, basically. We're taking loans that we have no intention of paying back. We're getting towards the later years, and you know, you're 80 years old, and I'm just going to take 118,000. It's at this point, it's kind of set up as supplemental income. You do not have to take this. That's just the way this illustration was set up. You can set up an illustration. You talk to your guy, your girl, whatever, and make sure you set this up. Don't talk to anybody. Don't go to your brother-in-law who sells life insurance, because whoever you go to is gonna, even though they say they've got your best interest at heart, they're gonna make some money on the deal too. Okay, so whoever your insurance guy is, you know, I don't put this stuff together, but if you want to get a hold of this guy, 𝐊𝐔𝐘𝐒, he's the one that has done my policies for me, and he's a great guy. Some other ones that I'm kind of connected to. If you want to get a hold of me, I'd be happy to put you in touch with these guys. And the MC is part of the Nelson Nash Institute, where they are the ones who really got the infinite banking concept together and thought this whole thing through and kind of got it all going. So those guys are certified through the Nelson Nash Institute, who those, in my mind, those guys are the top-notch guys. And they do sell these. They are stripping as much insurance as they can out of it, which means their commissions go way down. So if you ever hear of anyone, this is a whole life policy with a mutual company. If you ever have anyone trying to sell you an IUL or an indexed universal life, run. Those guys are making a shitload of money on commissions, and you will get screwed. I can almost guarantee it, unless the stock market never goes down, but that's a different video. So just kind of want to touch on this and show you some real numbers here, the situation that was put together. So if you got any questions, please let me know, and if this helps you, and happy investing.